Upstart Holdings announced financial results for the quarter ended March 2023. The company posted a net revenue of $110 million. On quarterly basis, the revenue has seen a significant decline of 27%. On yearly basis, the revenue has witnessed a decline of 64%. The main reason for decline in revenue is transaction volume, which has dropped from $1.5 billion to $1 billion, a drop of 50%. Given the nature of company's product, management has a unique lens into what has transpired in the last 2+ years and what may transpire in the coming months and years. The company is at the end of a unique economic cycle related to the pandemic that included two distinct phases. The first phase was triggered by a pandemic-constrained consumer spending and unprecedented government stimulus throughout 2020 and early 2021. These together drove significant improvements in consumer saving levels and liquidity, which in turn led to dramatic overperformance of credit during this phase. The AI platform experienced about a 50% reduction in credit defaults compared to the pre-COVID timeframe. In the second phase, toward the end of 2021 and into 2022, this effect began to unwind as stimulus was discontinued and consumers began to travel, dine out, and spend once again. And as expected, default rates returned to pre-COVID levels or in some cases even higher. While virtually all consumers benefited financially from reduced spending during the early stages of the pandemic, this cycle was concentrated in consumers who received government stimulus checks, a demographic which is also more likely to be Upstart borrowers. Going into the future, a significant slowdown of the economy and a worse than normal macro for the next year and beyond is anticipated. The company's 70+ bank and credit union partners, who typically retain loans in the lower risk grades appropriate to their businesses, have seen their portfolios consistently meet or exceed expectations since the program began in 2018. Institutional buyers have so far seen 12 quarterly vintages overperform, with 5 expected to underperform. Today, the company is operating in a funding-constrained environment, which is the primary cause of revenue shortfall. Management is proactively taking actions to address it. The company's goal is to operate as a marketplace for credit over the long run. They want loan transactions to take place when they make sense for the borrower and the lender. And certainly, lending is a category which would expect to experience some volatility over time due to macroeconomic factors. In the last few months, lenders and institutional credit investors reacted more quickly and abruptly than the management anticipated. Several of them have paused or reduced originations due to fears about the future of U.S. economy. These lenders and institutional investors have not left Upstart's platform, but have temporarily paused or reduced their originations. And given funding constraints, the management believes that the opportunity for lenders to generate strong returns on Upstart is unusually high right now. Yet, the reaction of lenders is often binary in nature, more so than anticipated. As a result, the company needs to upgrade and improve the funding side of their marketplace. This means bringing a significant amount of committed capital on board from partners who will invest consistently through cycles. They are currently evaluating a variety of opportunities to do just that, which will take some time to bring to fruition. The management has decided to leverage the company's balance sheet as a transitional bridge till the time committed funding is realized. The company operates with low fixed costs and strong gross margins. The company continues to add new lenders to their marketplace with the total of 71 banks and credit unions as of today, up from 57 in May 2022. Despite the cautionary outlook in the financial services industry, forward-thinking banks and credit unions continue to choose Upstart. Upstart has also expanded its auto retail lending product to 29 dealerships and saw the first $10 million in retail loan originations in the second quarter. Subaru and Volkswagen were the latest OEMs that announced support for Upstart Auto Retail, joining top franchise dealers from 37 brands that include Ford, Honda, and BMW. The company also launched its small business loan product at the end of June, well ahead of schedule. More than 40 small business loans have been originated totaling more than $1 million in principal in just a few weeks. The company is eyeing towards rapidly expanding this product in the coming month and years. Lastly, the small dollar loan team launched support for Spanish-speaking applicants, another giant step towards serving those left out of the country's mainstream financial system. The company's AI-based lending platform continues to perform well compared to alternate lending models. It is not reasonable to expect above-target loan performance irrespective of the economic cycle. So it's fundamentally important to separate the impact of macro conditions from imperfections in a credit model. The essential litmus test for model performance is separation of high and low-risk borrowers. In this test, Upstart model is shining brightly. Following recent share repurchase authorization, the company has repurchased approximately 4.4 million shares, totaling $150 million. Net interest income was a negative component of net revenue this quarter, as the company entered into multiple loan sale transactions, some of which incurred a negative fair value impact. The valuation marks of the company's remaining loans also continue to be negatively impacted by the rising interest rate environment. Contribution margin, a metric which the company defines as revenue from fees minus variable costs for borrower acquisition, verification and servicing, was up sequentially at 58% and 200 basis points ahead of guidance. As the management optimizes fees and marketing expenditure for lower near-term loan volumes, they expect that unit economics will continue to show meaningful sequential improvement. Operating expenses were $234 million in Q1, down 5% sequentially. Sales and marketing expenses were reduced by 21% sequentially, as the company downsizes marketing campaigns to reflect constrained funding supply. Engineering and product development grew 14% sequentially. Although by the end of the quarter, hiring has been significantly slowed down and most of the remaining hires were concentrated into key technical roles. Growth in general and administrative spend, however, dropped 15% sequentially. Taken together, these components resulted in Q1 net income of negative $129 million. Adjusted EBITDA of negative $31 million is down Q-on-Q basis. Adjusted earnings per share for Q1 was negative 1.58 based on a diluted weighted average share count of 81 million. Company ended the quarter with $322 million in unrestricted cash, remaining flat as compared to last year. For the second quarter, management expects revenues of approximately $135 million, representing a year-over-year contraction of 42%. Contribution margins of 60% are expected, which are above normal. With this, adjusted net income of approximately negative $40 million is entered. With the weak forward guidance, share price performance can show significant drop in the coming weeks. Here, investors have three choices. For those who believe in the AI-based lending platform and management, Upstart holds good promise going to the future. Once the interest rates are stabilized and uncertainty regarding future of U.S. economy is cleared, lenders will again come to Upstart for originating new loans. After a year or two, Upstart can show its true potential with significant growth in revenue. For those who like the company but want to be conservative, they can sell put options with strike $10 to $15 and keep earning premiums until the buying price is realized. For those investors who are too risk-averse, they can choose not to put their capital in a company with turbulent quarters ahead. However, we all should consider the fact that most businesses are cyclical in nature and high interest rates will invariably affect all sectors of financial markets. Moreover, Upstart can also be a takeover target as the market cap is low and any bigger company can be interested in buying a disruptive technology. For those who can take some risk, Upstart holds great promise for high returns.